Hello, CFA members and guests. Welcome to the first Macro Matters for 2025. I am once again joined by my co-host, Tony Zhang. Tony, welcome.
Hi, Rich. Happy New Year. And
Happy
it
New
has
Year
been
to
quite
you.
some time that we haven't really talked about the market and talk about the macroeconomic situation, given there are so many things have been happened over the past few weeks. So I'm very excited to come over here and discuss with you today.
Yeah, I'm looking forward to it. There's a lot to get to. Before we jump into looking at the different elements of the markets and movements in the markets, and we're going to show some slides as usual. Just wanted to remind everybody that Chicago, the CFA Society of Chicago, this year is very fortunate to be hosting the CFA Institute's live investment conference. It's going to be May 4th through the 7th. So make sure you I know many of us have shared it on our LinkedIn. You can certainly get it on the CFA Chicago website. This is the first live annual conference this institute has done since COVID. So we're bringing the lives back. And so this will be really good and definitely a chance to learn from industry experts, but more importantly, to network with people from around the world for the different opportunities. I know I'm going. I believe you're going too, Tony. I would look forward to seeing everybody there.
Exactly, exactly, and I think this is just coincide with like a centennial 100 years of anniversary for US CFA Chicago chapter. I'm actually quite excited for these two things just happening at the same time, so we can actually have a networking with a lot of financial professional globally. I think this is a great opportunity for everyone to participate.
Yeah, you're absolutely right. I don't think many people realize the CFA Society Chicago not only is one of the founding members of the CFA Institute, but also is turning 100 years old, is the oldest investment society in the world. So it's pretty exciting, and I think there's a big slate of things planned this year. So look for that in your emails. But certainly, one of the big features is going to be that live conference. So Tony, I know since we last talked, we had elections, we had all these different moving parts, et cetera. Coming into this year, I've been really trying to focus on what matters most. I think trying to distill it down to one thing. Ultimately, for me, it's the 10-year yield, because the 10-year yield encompasses not only what the Fed's going to do, it encompasses what the Treasury and fiscal policy, so not just monetary policy, but fiscal policy, is impacting the markets. It also talks about, tariffs and deficits and things of that nature, but how money is flowing around the world, where the opportunities are around the world. And as we've talked about before, our 10-year yield is the basis for pricing just about everything else in the world, including other sovereign debt, corporate credit here in the US, mortgages here in the US, and even equities. So why don't we jump in by looking at initially, I'm going to share my screen here. For those that are listening to it on podcast, we'll talk you through what the screens are. But for those that can see it, we're bringing up the graph of the 10-year Treasury yield. And I've got it here. The 10-year Treasury yield is in white, and I've got it versus a couple other things. I've got in orange, I have the inflation swap index, the five-year forward inflation swap index, which gives us a measure of what the market thinks inflation is going to be doing over the next 10 years. And then the blue line is maybe a little controversial, maybe not. It's the term premium. It's the 10-year term premium, which is, in theory, in academics, it's what investors demand to lock their money up longer term. And so what I'm trying to show here, Tony, is that even though the Fed cut rates, they cut by 50 basis points back in September, but literally to the day, 10-year yields have been moving higher since that September FOMC and have marched quite a bit higher. We're now 81 basis points higher after this pullback than we were. But at one point, I think we were up a little. We were up definitely over 100 basis points higher. In the 10-year yield, driven primarily. I mean, not there's some element. Probably about 25% of it was from increasing inflation expectations, which maybe the CPI and PPI have kind of tamed down here for the time being. but really it's that term premium. It's the amount, it's the investor saying, you know what, if I'm going to invest longer term, I want to get a little bit of a premium over cash. And that term premium, I don't, I'm not showing it here longer term, but that typically has averaged between 1.5% and 2% out to
Mm.
10 years. The Fed had suppressed that and actually taken it negative, after the financial crisis and even after COVID. And now it's creeped up back into positive territory. It's only about 50 or 60 basis points. So it's still far below what it normally is, but it's gone up quite a bit. But that's definitely impacting 10-year yields, and 10-year yields around 4.6. I know we looked at these last summer, and I was thinking that we could move to 5%. At that point, I was wrong. I'm still thinking that there's probably more upward pressure on yields than there is downward pressure on yields. But to me, I think that's the story here early in 2025 is this 10-year yields and the impact on the rest of the markets. But I wanted to get your take on what you're thinking about those, Tony.
Yeah, Rich, I think you cover a very important point here, which actually one of the underlying factors for a lot of the companies like earning growth prospect, especially for the for the small cap. Because what's happened over here, like as the 10-year yields continue to spike since like I think the presidential election result came out in last November. Here we can see it very clearly from this graph, and a lot of people would feel like what I would say contrary to what they believe, because as Federal Reserve came in and continued to cut the interest rate, people would anticipate the 10-year Treasury yield should decline instead of a rise, right? So this is a very general understanding. But what if you actually look at this, like different from the market's belief, this is a 10 years you continue to rise. It could even actually to a point that went above like almost 4.8%, like which at the high that we saw in the middle of April last year. That actually caused a lot of concern for market participants, especially the institutional investor. The there could only be two underlying reasons or explanations behind that. One explanation would be now the inflation could go much, much higher over the long haul. The other explanation is US economy will become much, much stronger over the long haul, right? I, this will be only two underlying factor or force, driving force behind that. And which actually force would take the lead would depends on the the market, or especially the stock market and bond market's performance as well. If
Yeah.
it is because the stronger U.S. economy going forward, now that is, people anticipate the earning growth of the large company and small company as well will remain strong, and in a sense which would enable the company to actually deliver the financial return to investor. But if it will be the inflation which actually dominated the factor, the high yield factor here, people might anticipate the Federal Reserve might slow the pace to cut the interest rate. Now, we have been in high interest rate environment for quite amount of time. There are a lot of reasons behind that. We actually cover that in many episodes last year about what are behind the high interest rate environment, why Federal Reserve continue to slow it down to cut the interest rate much smaller than market anticipated. And we were right at the beginning of since the beginning of last year that we never anticipated the market, the Federal Reserve to cut so aggressively as the market anticipated, right? Market always anticipated, so it could be more cut than the
Yeah.
reality. So, and that was the reasons like S&P and I think large cap also deliver strong performance last year. Now here it will be the two major factors, like which factors can will be the dominant factor really can determine the outcome for the performance this year. Rich, this is how I'm thinking. So it's like, what do you think? Which factor might be the dominant factor here? Will be the inflation, or will be the strong U.S. economy growth here? This is a question mark.
Well, that's a great question, and I might even suggest that they're not necessarily separate. But as you can see, the bond market, as you look at these lines, the bond market really through probably October or so was tracking the inflation expectations very, very closely. The bond market definitely cared about inflation and therefore what the Fed was going to do. But since then, really kind of October, November, and since the election has really been tracking a lot more, maybe the term
Yeah,
premium and that's I think because of the election, maybe not because of necessarily just the new administration, but really either administration was going to have to face the problem of the fact that we have $7 trillion of Treasury issuance that has to come out this year.
yeah,
The Treasury sector is going to have to sell $7 trillion of bonds into the market, and it's going to have to find a price. And what we're seeing is that a lot of the price insensitive buyers that we've had for the last several years, right? We've
mhm,
had financial institutions looking to buy bonds because the regulators told them they had to buy bonds. But since the Silicon Valley Bank blow up, that's really kind of backed off a little bit. We've
mhm,
had foreign buyers have always been a big source of buying here in the U.S., but we've seen the economy is struggling around the world, but now with the potential tariffs that are coming on, foreign buyers are probably looking to step back a little bit. If trade flows slow down, that's less dollars to recycle into our market at the very least. And so therefore it becomes the US retirees, the baby boomers, who are the ones who are going to step in and fill the void. Um, and I think they're more price sensitive. I think they're looking for higher yields. I think that's why one of the reasons I think that we might see generally an upper pressure on yields is because there's a little bit more price sensitivity. But I think to your point, I think growth definitely looks much better than I think a lot of people in the market were expecting. The data is coming in good. The
yes,
ISM has turned up. The new orders to inventory ratio, which tends to lead the ISM, is also turning higher. And so growth is definitely picking up. The jobs numbers have been looking stronger. The one thing that maybe gives me some caution on on the growth overall is the fact that through the end of the year, the housing market didn't look like it was recovering or was picking up. But the last housing numbers we got, housing starts and buildings permits, were better than expected. And so maybe even the housing market, even with mortgage rates up at 7% or so, even the housing market started to show some life. And so to me, it looks like growth may continue to be able to deliver here with inflation that hasn't come back down to the target, right? We're looking at the 10-year
right,
inflation expectations here of 2.56. The bond market rallied considerably on the CPI data that came out last week, but that was inline CPI data where the headline index was at 2.9%. And so there was this huge excitement over a number that was at 2.9%. And month over month, X food and energy was zero point 0.2, which is what a lot of people point to, but
correct,
unrounded, that was 0.23. And if it would have been 0.02% higher, 0.25, it would have rounded up to 0.3. And maybe there would have been a very different reaction. And so, to me, I think inflation still hasn't been defeated, if you will. And if growth is going to remain strong, that tells me that maybe there's even upward pressure on inflation. And so the Fed still has its work cut out for it, on that front. And maybe that's a good segue to look at inflation expectations here,
correct,
because here we are, with a Fed meeting next week on January 29th. There's no expectations for any sort of move next week. But if we look at this, and I have the interest rate probability page up on Bloomberg, and if we look at it, we don't have a full rate cut priced in at this point until July, and if we look over the course of the year, we only have about 1.5 rate cuts priced in um, at this point. But still, that might be 1.5 rate cuts too many. If growth is going to stay strong, if the jobs data is looking strong again, and inflation still hasn't been solved, does the Fed really have the impetus to cut rates? Some would say that rates are restrictive. I'm not so sure I agree, but what do you think about that? Are rates restrictive enough that the Fed has to cut rates here?
yeah, Mitch, Rich, to really, I think answer the question that you just raised. I think it's very important to revisit one of the comment that you mentioned about the sales of the new Treasury this year. I think you pointed out there will be like $7 trillion dollar of bond sales potentially this year. This is actually a very significant number that no one actually can overlook, right? And if
Right.
we actually look into this, like who could be the bond buyers both domestically and internationally. Domestically, apparently, we look at the institution endowment fund. Apparently, they are the buyer mainly. Historically, I think that will continue to be the case. But if we actually look outside the U.S., in the past it was China, Japan, and England, right?
Yep.
And I think the central bank of China and Japan was mainly the net seller of the U.S. Treasury over the past maybe 2 to 3 quarters. And it was very interesting to actually see the Central Bank of England actually raise up to the top level of the U.S. Treasury buyer. So that actually is telling us a lot of information. That being said, it's like given such a big amount of like incoming treasury sales, who will actually take over this kind of a treasury yield in addition to maybe Fed. It could be the case that Fed by itself will be a net buyer. That basically means Fed we would have to actually curtail their current restricted rate policy and do maybe having a new round of quantitative easing QE and maybe enlarge their balance sheet. This is the one of the options. And if we actually look at the other way around, like whether the Federal Reserve can continue to hold the interest rate for so high for extended period of time, you mentioned about the housing market. I think this is a lot of people. I think everyone would have a sense about the situation of the housing market here. Since COVID, we know the price and the living costs of the housing market has risen significantly, and it's very difficult, as we discussed last time, that the new graduated after graduating from college cannot even afford buying a house or small house in or most of the major metropolitan cities. American dream is become harder and harder and harder, right? So
Yep.
that's one issue here. But given under the high interest rate environment, what could really suffer or what could really shock people here, I think in addition to housing market, I think the commercial real estate is one sector where the potential the black swan could really happen. Now, the cap rate is less than the risk-free rate at this moment, so less and less of the capital would invest into the commercial real estate market. And who actually own the actual commercial real estate? It will be the small and middle size of the bank, which actually in the past finance the building or finance the implementation or construction of this kind of a commercial real estate. And since like year 2020 and to this year 2025, it has been a 5 year. So it will be the time for lots of the I think the developer to refinance the data financing. And at this moment, whenever they actually refinance, the situation is completely different from what they did in year 2020 when the interest rate was close to zero. Now they are facing extraordinarily high interest rate. That could cause a lot of turmoil in the commercial real estate market. And if unfortunately, leading to the turmoil in the small and mid-cap financial industry, then this could really cause a lot of trouble here. If we actually put everything into consideration, will Federal Reserve have the tendency to continue to hold the interest rate for extended period time? That's actually a big question mark. And a lot of people will also think, given like $7 trillion new bond sales, what about the interest payment on the current new
For
bond
sure.
sale,
Yeah.
right? The interest rate
Yep.
And it's almost like more than 30% of the US annual GDP just to cover the interest rate. The last year, a lot of people already, investors already noticed the interest payment annually is even higher than the annual, like, I think the defense budget for the US
Yeah.
whole country, right? This has become unsustainable. Now, if we look at the sustainable investment, the sustainability of like a financial market here, a lot of I think issue, if exploded, can cause significantly suffering for all of the investors into the US market. So that's what really concerns me, Rich.
Yeah, I just wanted to bring up a chart here while you were talking. We talked about this. You said the sovereign debt owners, who's going to buy the 7 trillion. So I brought up the chart of the sovereign debt ownership, and you can see here over the last couple of years, the amount of, if we look at it, in the last 2 years, the amount of U.S. debt's gone from 21 trillion to 26 trillion. That $5 trillion, that has entirely been absorbed by other holders, and if other holders are really, uh, that's primarily that kind of U.S. investor,
Yes,
mostly kind of retiree. You can see the Fed has been reducing some of their holdings. Foreign holders have kind of stayed flat, maybe gone up a little bit. But if we dig into the foreign holders a little bit more specifically and look at who it is, China, if we drill in China and Japan. China's reduced their holdings a lot, as you said. Japan's reduced their holdings as well. UK holdings have kind of gone up a little bit, which has kind of kept the overall number flat.
yes,
UK and Luxembourg are seeing their holdings go up, so that's most likely foreign financial institutions coming through those markets that are buying those.
right.
But yeah, the sovereign holders in China and Japan are definitely reducing. So that's kind of that's a big point of it. And maybe it's just sticking on the interest rate theme. One more thing, we want to kind of look at maybe the yield curve, and the yield curve has now here for the last few months started to re-steepen past that inverted level. Right, we've been inverted for a very long period of time and
Uh,
severely inverted.
yes,
And every time we've had an inversion in the past, I have on here the recessions. I'm looking at the 1 year, 10 year part of the yield curve. And every time we've gone below zero, we've had a recession. This time we haven't had a recession. Who knows why we haven't had that? But we usually, when we see this reinversion, that's typically the point when, when we do see that, you see that it's not the inversion that causes recession or leads to recession. It's when it kind of reinverts that's typically right when we see a recession. It doesn't seem to be any sense that we're going to have a recession right now. But the reinversion does actually give the fact that the curve is a little bit steeper is going to give the banks a little bit of a chance to have a little bit higher margins and to earn some money. And we're here at the start of earnings season, and we've certainly seen that from the banks early on, is that we're seeing a lot more earnings coming out of the banks, et cetera. And maybe that segue we can talk about real fast. You mentioned it before, earnings, right? Um,
right.
so I just have a chart up of the S&P 500 versus the Russell over the last 15, or sorry, the last 20 years actually. And we see really it kind of didn't go a lot. It didn't go anywhere. It was kind of sideways, a little bit volatile. And then starting in 2021 is when really the large cap stocks have just absolutely massively outperformed small cap stocks. And sure, there's an element of that, which is maybe a preference for Mag 7 for the AI theme, et cetera. But the fundamentals have been what's driving this. Small cap earnings for the last several years have really struggled and have not really gone anywhere, whereas large cap earnings, particularly the Mag 7, have been very, very strong. And so it's been an earnings story that's been
Mhm.
leading to this outperformance of large cap versus small cap. Is it time now where we might finally start to see some small cap earnings coming through? Because I think there's a lot of people that want to believe in picking the bottom on the small caps versus the large cap, but the fundamentals just haven't been there to support it. But will maybe the fact that we've gotten some rate cuts, maybe the fact that the economy is staying strong, maybe the fact that we'll get some cuts in regulation from a new administration, will we finally see some earnings support to the small cap where we might see some rotation out of large caps into small caps. What do you think?
Right. Rich, to a certain extent, I actually agree with you. So we do see some potential opportunity to invest into the small cap, given the sluggish performance of Russell 2000s versus S&P 500 over the past couple of years. Actually, if we look at the chart you are showing here, since like 2005 and year to date, it almost being like 20 years, we can easily actually spot just from the graph shown here, almost over
Yeah.
the whole decade, like 2 decades, like that a small cap has been underperforming the S&P. Now, apparently, one of the major reasons was that the large cap tech outperformed significantly due to the earning growth rate that have been continuously shocked the investor and appreciated by the market. Now, the second factor will be, I think, from the small cap company will still suffer from the earning growth, especially under the high interest rate environments. Many like a small cap company they are not profitable. If we actually look at Russell and look at the components or constituents within the Russell, mainly the overweight sector like financial, healthcare, and industrial. Those sectors actually are not that profitable. What that means is to continuously to operate their business, they have to really do the data financing, which actually would really rely on the interest rate set by the banks for them. And those under the high interest rate environments so far and in extended period of time, their profit and their earnings growth are still not that optimistic as what you suggested. And I actually agree with you that fundamentally we haven't really seen a major pivot point for the small cap uh, company yet. And in the CFA, I think annual dinner event last year, here Chicago here, we actually invited the people to talk about the small cap prospects in year 2025. And many of us would definitely agree. So fundamentally, we will continue to see the small cap would suffer. However, this could be some positive sign here that Federal Reserve might actually cut the interest rate more aggressively than what they actually set at the tone. If that's something that what's going to happen, given what we actually mentioned previously about any issue. Now what we have here, we have a Fed which is willing to actually has room to cut interest rate more than the market anticipate at the moment. That could really help the cutting the financial distress of the small cap company. From what I would say maybe tactical allocation perspective, small cap does actually have some kind of value, but overall I think many institutional investors will still prefer large cap tech situation. Apparently, one of the factor that investors should consider is the deregulation within some industry, especially the financial industry, which has been highly claimed by President Trump. So he actually pro the deregulation for financial industry and actually many industry in a sense to actually pro the economic growth, to pro the growth of a small business in that sense, like a small company or Russell 2000. Some of the companies might actually have opportunity to thrive in this environment. So that being said, overall, I anticipated that small cap would still underperform to certainly then to large cap S&P this year, but within certain sector or certain like small area, some company which can manage well with like the regulation, I think should have a great chance to shine and then maybe to contribute to the return for investor. That's how I envision, Rich.
Yeah, you touched on a lot of great points there. And I mean, I just kind of switched the charts around. Before we were looking at the SPX versus Russell, like, and it showed the Russell outperformance versus SPX outperformance. I just kind of inverted it here, and I have the Russell divided by the SPX, and so it shows the underperformance, particularly over the last 5 years. And I've overlaid that versus the National Federation of Independent Businesses Optimism Index. And what we've seen is kind of what you talked about, that regulatory burden, right? So under President Biden, regulations have gone up considerably, and small caps have felt the weight of that, and have really their optimism has fallen, to all-time lows. And just in the last month or two, since the election, we can see a massive spike in small business optimism. It's not that necessarily that the actual fundamentals have gotten better, but we can see small business owners feel tremendously more optimistic than they have at any point in the last 5 years. And I overlay that versus the Russell, underperformance versus the S&P. We have not seen the index catch up here, but this is the one where you look at that, and then that's kind of to your point, where I think people are saying, if small businesses are more optimistic, will we finally start to see the fundamental story playing out because of lower regulation, which is going to lead to more profitability, which would lead to small cap outperformance? And is that the most clear trade of a new administration? Is this kind of transition from small cap to large cap? Like you said, nobody believes that right now. If you ask anybody, they want to own large cap tech and AI shares. But as we both know, having looked at markets for a long time, when everyone wants to do the same thing, it's probably time to look into other areas, because maybe a lot of that news is getting priced in, even though I think we both believe that AI is going to change everything and increase productivity and lead to a lot more earnings. And so there's a lot of reasons to love the AI story, but maybe for at least in the near term, some of that's getting priced in, and there's maybe some other places for people to look.
Yeah, Rich, there was actually a point and evidence that support that argument. If we actually look back year 2017 and year 20 or early 2018, it was actually the first son of President Trump who actually did it, the direct regulation, which actually just helped the market actually continue to recover and eventually just deliver very strong performance. So we actually saw it that he did the direct regulation, and deregulation would really be appreciated by investors, I think both domestically and globally. So to a certain extent, it's not, I think, a mistake for many like small cap investor to be optimistic about the impact or the effect of the deregulation, especially what we know that the financial industry, and especially last week that we saw the very strong earning announcements or earning performance from many like big banks, right, which actually
Yeah.
delivered almost historically performance or earning revenue. So I think that's actually telling us a lot. We know that those kind of banks that they typically they benefit from the high interest rate environment because financial industry banks actually they profit from the interest rate spreads in high
Yeah.
interest rate environment. Definitely they benefit, and with more of a deregulation, we would anticipate, or it's very likely that small or mid-sized banks can generate higher actually revenue. At least they can reduce their SG&A with the compliance. This is one thing for sure.
Yeah,
So
absolutely.
so here is like I actually remain very optimistic about some certain sectors in the deregulation era. If President Trump really actually signed a lot of executive orders as what he did on the first day. Uh, so we will continue to see that what actually are coming out.
Yeah, no, I think you're right, and that's we can't lose sight of the fact that, when we're looking at Russell versus S&P, there's definitely, it's a large cap, small cap bias, but there's a sector or index composition part of
Correct.
that, and Russell has a lot more financials in it than the S&P does. the S&P has a lot more tech in it than the Russell does. And so,
Yeah,
in some ways, you are looking at tech versus financials here. And financials definitely benefit from a steeper yield curve, as you kind of
yes.
mentioned here. And so maybe that's another potential catalyst. One other thing I wanted to ask it and get your thought on. We like to talk about factors, et cetera. And here I just have the Bloomberg pure growth versus and then the Bloomberg pure value factors over the last 10 years or so. Growth versus value. That's another one. If you ask a lot of people, why would you want to invest in value? Growth is where it is. It's all about, again, it's all about AI. It's all about technology. It's all about growth. But we've certainly seen, just here very recently, seen value perking up again. And in my work and when I've kind of seen, it's value tends to do the best in an absolute and relative basis when we have higher inflation. And if inflation is going to stay with us, is that a chance um, for value to maybe outperform? That there's a logic to it, right? Because when you look at value companies, they tend to be ones with high fixed costs, which is why they have a lower multiple that investors will pay on them. And high fixed costs will do better in inflationary environments because um, you know so much of the higher pricing that they're able to get drops to the bottom line. Whereas
Mhm.
growth names tend to have very low fixed costs and high variable costs, and higher inflation will erode at the margins of those asset light businesses because most of their costs are going into human capital, which are demanding higher wages. And so,
Right.
will we see if inflation stays with us, will we see a return of value? We certainly saw value massively outperform growth when we go back to that inflationary episode post COVID. That was a time when value um, definitely outperformed growth for a couple of years. Is that a time when is that something to look at? But I mean, growth um, has definitely been where people want to be. So, any thoughts on these factors?
Yes. So actually, yesterday there was actually a big event. I hope many investors should pay attention to that. President Trump actually, together with the CEO from SoftBank and Oracle, OpenAI, they announced like 500 billion of investments over the next 5 year investment into the AI. This is about the technology, about the tech. At least this is something we can say for certain. We continue to see this like high investment into the tech. That being said, it's like whether we see maybe some sector rotation from growth back to value. Here we actually need to sometimes we need to track where the capital will flow in. Now is at least from the announcement yesterday, we know that right now the capital will continue to flow into the tech. From investment point of view, if we actually think about the risk adjusted return, maybe the tech sector will still have a lot of potential actually to go. Now, when going back to talk about like when it's actually might be a time to invest into the value. So typically, I would say value stock or value-oriented sector like a financial, industrial, and material and energy. It's like those kind of value sectors tend to do better when market anticipate the rising inflation, as you mentioned that, and higher rate, or when the economy is in the mid or late cycle, like environments in which like undervalue companies with static cash flow become more attractive than high growth but high price tech stock. Now the valuation for like Magnificent Seven, definitely, I would agree with many people who'd argue that the valuation for Magnificent Seven at this moment is not cheap, but it's not actually that pricey or not super expensive, given they're like still 30% or even 50 or 60% of any growth rates. Um, in that sense, we actually have to fall down to the second question: is current economy at the mid or late cycle of the growth? If we look at the investment and look at job employment data, we actually are not in that level yet. Um, all of this kind of a thinking that data suggests we are still in more like an early cycle of economic growth, not even the mid or not even the late cycle. So in that sense, in statistically speaking, in this kind of a economic cycle, the value sector or value stock tend not to do better than the growth stock. So that's macro economic perspective. And given right now a lot of announcement and going forward, and as what President Trump suggested that we might be in a golden age of America, so whether we believe or not, okay, and investment into the tech will still be the dominant factor. And everyone know that we are in the AI competition and here globally, and we have the best like capital, we have the best intelligence here in the United States. I'll actually would argue that still growth stock and especially tech heavy stock might have still a better chance, or at least have a less of a certainty to continue to outperform if there's no black swan. When we talk about black swan, it could be something like another COVID, or it could be nuclear war, then
Yeah.
geopolitical tension, right? Due to the kind of thing. So if we actually look at this, like President Trump, it's not a war actually pro type of president. So if we can actually see the kind of ceasefire in Middle East and between Ukraine and Russia, everything would actually favor strong economic growth. Even the inflation is to remain high, and even we will continue to see historically government bonds sale. So all of the factors, so we might be able to find a trade-off. And if we are fortunate enough, we should see a really compromise, which tend to be favor still the tech growth, at least in year 2025. So year 2026, as what you suggest, whenever the yield curve turn from inverted back from from the negative region back to the normal region, and after 6 or 12 months, then we actually tend to see recession. And so far, maybe in the foresight year 2025, that might not happen, but we would watch I think the earning growth of the company, earning report of the company significantly or very closely in the coming weeks. Rich, that's how I take away how I actually look at the market right now. What do you think?
Yeah, I mean that's a great point that you make that that the economy, the cycle, the business cycle here looks like it's much longer than a lot of people were anticipating, right?
Uh,
A lot of people initially thought, well, there was going to be a full-on recession in 2023, and that wasn't the case, and so maybe now it just looks like it's a bit longer than everyone thought because of this tech revolution, this AI revolution, and that's a lot of what we saw. Why we had a soft landing in the mid 90s that extended that cycle and
Very true.
ultimately led people that want to draw comparisons to the current market and 2000 tech bubble. um, and they may be right. My only pushback is, how do we know it's 2000 and not 1997 or 1998? Because
Very
the
true.
market continued to go up like another 100% at that point. So being on the sidelines for that is a difficult one. But that also kind of begs the question then, and you mentioned the 500 billion coming in from SoftBank, and what we're seeing, the headlines that we see in terms of the investments being made, et cetera, again suggests that there's plenty of liquidity in the system.
Yes.
And you mentioned at the start the potentially maybe even the Trump coin, and that was one of the big stories. And I don't really want to talk about the Trump coin too much because
Correct.
most people probably don't care about it. But I know you follow crypto a lot. I follow crypto. I think when you see these types of altcoins or meme coins going up so much so quickly, and seeing the amounts of money that kind of flow into them, it tends to make me think that there's this a lot of money moving around in the system. I brought up the chart of crypto here. We can see Bitcoin almost at 105,000, so well above 100,000. Ethereum has also moved up quite a bit, but not as fast as Bitcoin. So usually when we see money, a risk on a risk on type of flavor, not only is crypto doing well if when there's risk on, but usually it's the altcoins. It's usually Ethereum that's outperforming Bitcoin in those types of markets. That is not the case right now. Bitcoin's been, I think the Ethereum Bitcoin cross is at a 4-year low. So Bitcoin has definitely outperformed Ethereum. However, quietly, Solana has massively outperformed Bitcoin, and Solana is the chain, is the network upon which these recent the Trump coin, the Melania coin, some of these a lot of these coins have kind of come to market on. And so is that any thoughts on what we're seeing in crypto right now? Good news, bad news? Is this a sign that crypto has gone fully mainstream? A lot of people who have been in crypto for a long time thought that maybe this was a negative that we saw some of these coins. Just a general sense of the crypto environment, Tony. What do you think?
Yeah, Rich, you are right over here. Apparently, the issuance of Trump and Melania, meme coin, apparently very controversial. Now,
Yeah.
everyone knows that President Trump is the crypto pro, so he actually support that adding maybe the Bitcoin into the U.S. government currency reserve. And as a matter of fact, many investors or many lover of the cryptocurrency embrace that ideology. So they bought the Bitcoins heavily since I think President Trump won the election. So that was actually the story behind the strong performance of Bitcoin over Ethereum. Over that, like a lot of people will speculate that President Trump will actually sign an executive order to add the Bitcoin into the U.S. Central bank currency reserve, which hasn't happened yet. So there is still as high expectation. So over the today or maybe over the next 2 days, President Trump will sign some kind of executive orders. We don't know yet, but it could be the case. He hasn't really mentioned too much this in his inauguration speech, neither like in the speech like the night before inauguration. So we haven't really seen that. But given that Elon Musk, who also pro or favor about cryptocurrency, same as President Trump. So we might anticipate this kind of things could happen. There are a lot of reasons behind the embracements of the President Trump over the cryptocurrency. Now we can actually look at the issuance of the Trump meme coin or meme coin, Millennium meme coin. That's definitely to show, I think, from a president or United States perspective, that he favored the investment into the cryptocurrency. Otherwise, he won't do that. This is unprecedented in the U.S. financial history. Well, to be clear, Ming actually, if he issued the Ming, he's not issuing the Ming coin. I think he issued the Ming. Ming is a slightly different. Sometimes could be an like any image that he actually apparently utilizing the image to show in the his assassination attempt to show his courage in that one, right? Okay, but
Mhm.
it's not a cryptocurrency. It's not a crypto. It's just some kind of could be looking as an art. But whenever it was actually tied to the cryptocurrency, especially people have to actually buy it with Solana because it was actually released in over the Solana um, network. That's why Solana outperformed the rest of the major cryptocurrencies significantly. That was actually the main reason. But he actually utilized the issuance of the meme coins, I think, as a stand to show that he support the cryptocurrency. So everyone would anticipate that the regulatory environment for cryptocurrency over the coming 4 years will be less, I think, strict than the last administration. This is something for sure. SEC also, I think, say comment that they established a crypto task force yesterday. I think he want to use it to show lower, I think, the concerns of the media, especially in the mass investors and institutions about the cautiousness of investing into the cryptocurrency. You know, in Biden's administration, we know a lot of institutions hesitate to invest into the cryptocurrency just simply because, like, I think the regulatory environment was not that friendly, and he actually utilized to show. I think that if this is just the one thing, I think it's slightly shallow. There could be another reasons behind the issuance of the Trump or millennia. I mean, in my opinion, a lot of a speculation could happen, but apparently now he showed as one chance, one maybe case to raise capital from a campaign perspective before he's swarmed into the presidency, right? I think this is a show like positive signs over there, but from the negative side, there's a lot of concerns and risk and management issues involved into the issuance of the main coin. We saw that since the issuance of the Trump's main coin, over the 24 hours, we have seen that the Trump's main coin price rally almost, I would say, more than 20,000%
Yeah.
over 24 hours, and
More
then
more than the SPX has in its history. And it did
yeah,
it in
yeah,
like
exactly,
12 hours or
exactly.
24 hours. Yeah.
That was actually extreme volatility actually have been showcased over the price movement in history as well. That being said, given the high volatility and high risk involved into the investors' enthusiasm over there, I would actually argue for the cautious of investment into this kind of new cryptocurrency without I think really understanding the intrinsic value of the assets underlying. This is well, from I think from academia and from institutional investor perspective, need to be very cautious given this like situation. So we will continue to see what kind of policy would come out for the rest of the week, and we'll continue to actually discuss and monitor the ongoing development of the crypto market.
Yeah, I think you're right. I think we have to be really cautious and of here. The on the plus side, I would say that maybe what the meme coins generally show is the possibility of a lot of personalities, if you will, maybe unlocking some value behind their personal brand, I guess
Yeah.
one might say. But I think again, I think there's might be a little bit of buy the rumor, sell the news here if we don't get anything signed. Because of the volatility, I personally think the odds of the central of the Treasury, owning crypto in reserve is very low. But you know
Yeah.
what? With this president, you can never say never. So I would not I would not go too far out on that. I know in the interest of time, we're kind of butting up against it here, Tony. But I wanted to just get your thoughts on one last thing, because when we look at the we started by talking about the U.S. Treasury 10-year yields, but the China 10-year yields this year have kind of starting last year, but continue have hit an all-time low. Right, we're at 1.66%, and the China 10-year yields. Many, myself included, think that China looks like Japan did in the early 90s because of the demographic problems, because of the property that was overbuilt. We just had we had the Evergrande problem a few years ago, which we talked about on a podcast. We just had another property developer, China Vanke, have some liquidity concerns. So maybe there's some property issues. We know property is a very important asset class for Chinese savers. Um, China really has to struggle to get its own economy going right now. Maybe it won't be able to export its way out of this because of tariffs. Has to focus on the domestic markets. Investors seem to be suggesting that China is going to have to really be stimulative to get the economy going. Obviously, this impacts a lot of things. It impacts the flow of the potential buyers of U.S. Treasuries, but it impacts commodities. It impacts second largest
Yes,
economy in the world. It's going to impact a lot of things.
yes,
Just wonder your thoughts on what we're seeing in China and the Chinese bond markets, et cetera, Tony.
yes. It's actually quite complicated to really explain what have been going on in the second largest economy in the world. Now, if U.S. investors saw this, U.S. investor will be extremely happy if this is like a 10-year treasury yields in the U.S. Right?
Mhm.
I'll anticipate the U.S. stock market will just explode all to the roof, or also to the moon. But if we actually look at in the Chinese economic market perspective, this actually is telling the Chinese economy is actually on the um, recession concern, or in to a certain extent the recession crisis. Now we know Chinese government want to actually stimulate the economic growth domestically by actually stimulating the domestic more of domestic consumption. In the past 10 decades or 15 years, China grow the GDP, grows the economy mainly through the export. Given the low price and low cost uh, competitive advantages like versus US and the rest of the world, that helped China to grow the GDP economic very, very fast uh, over the past 2 decades. However, since the decoupling, since like 2018, the US and China started the what we know the trade war, and which actually could resume since President Trump took over the office again. And now this actually gave a lot of pressures and caused like very pessimistic sentiments in into China. However, okay, if we just look at this, like why this could happen, and will this be any, well, from our perspective, would there be any investment opportunity here? Which is by looking at this like extremely low 10 years yield. One way we look at that is China could face some recession crisis. On the other end is, what if China and the US can actually reach to certain agreement um, together, then can create a win-win situation for both U.S. and China economy. That actually could be a great thing. If China in the past can continue to export the deflation into the current U.S. economy, which is under the inflation environment, so this actually can neutralize, right, to a certain extent.
Right.
Now here it's what you suggest and what you point out. Chinese economy mainly in the past, like a lot of Chinese citizen, and they actually they store their assets into the real estate market, and most different from the U.S. I think investors and U.S. citizens who actually own most of their assets into the equity market. In China, Chinese citizens pretty much store the value in the real estate bubble. I think 90% of the house, each household own one either condo or either like a living apartment in China, like which is actually much higher than that number in the U.S. nowadays. That being said, is whenever we see some recession, this kind of low interest rate environment going forward, Chinese government really try to incentivize the people continue to actually uh, to have maybe to buy more of the real estate to support one of the major, I think, the sector within the Chinese economy. Whether their policy to stimulate the domestic consumption could become successful or not, that really depends on whether the real estate market can become stable and stabilize from now on, and looking forward. Chinese economy also face another aging situation, which means that more and more like um, people become elder and with less of a newborn, as what we have seen that some of the data, newborn infants, like we would anticipate that China might experience or concern China might experience what have been deemed as the lost decade in Japan history in 1990. So this is really, to a certain extent, really concerning. But from investor perspective, if people is willing to take a contrarian perspective point of view, maybe under the crisis environment, this could be some opportunity to really supercharge the investment return to a surprise, you know?
It could be, but I wonder if that supercharges the investment return in the United States. Because I think this is probably the biggest argument for why U.S. yields won't go higher is because
Yeah,
they're already 300 basis points higher than China. And so
exactly,
from a
exactly.
relative opportunity standpoint, it does look that much more appealing. And if we're going to go draw that 1990s analogy, as we talked about before, one of the reasons why U.S. assets did so well and why there wasn't the inflation that we saw was, and then we saw the assets here do well, is because we had the Asian financial crisis, which then became the Russia and Brazil financial crisis. So the money in those markets had to find somewhere else to go, and the U.S. market, with all of its opportunities, was the place to go, and that's where it went, and that's what we're kind of seeing right now. And so that's why I wonder that even if markets look overvalued to many people, if we aren't in the 1997, 1998 phase, and there's still a few years left to go because of what we're seeing abroad. Well,
Right.
I know we've been about an hour, Tony, so I really appreciate your time. Again, reminder to everybody to make sure you sign up for the live event that we have May 4th and May 7th, CFA Institute Annual Conference coming, finally having it live after having it been virtual for so long. Great chance to hear from a lot of very intelligent people from around the world, but also a chance to network, and of course a chance for people to come in and talk to the both of us, Tony. So who wouldn't want to do that, right?
Exactly, definitely. Looking forward to that's kind of exciting year, and this everyone heard about, talk about the January effect, and so far, for the first week that we actually saw some volatility, and maybe for the next 1 week we might continue to see volatility, but let's actually recap what happened in January, maybe in the next episode.
Yep. Yep. I think you're absolutely right. The January effect is a really good thing to look at in the next episode and see, um, you know, what does that really mean based on what we saw, and does it make a big difference? And then we'll also have some earnings and a Fed meeting to talk about. So we'll talk to you in another couple weeks where we have a lot more to talk about. But it's good to get the first macro matters of 2025 in the books. Thank you to everyone that listened, and we look forward to talking to you in a couple weeks.
Yeah, thank you, everyone. Thank you, Rich.